Welcome to another WorldMiner session. I'm Ola Johanneslin, the CEO of WorldMiner Global. You're all invited to access our platform, install the application, become part of our community. And you can follow us on social media, X, Instagram, Facebook, YouTube, and Medium. Don't forget to visit our website, worldminer.io, if you want to know more about our project. Our apps are available for Android and Apple. And share and become part of our Telegram communities. You can join our channels, WorldMiner Global, WorldMiner Brazil, or WorldMiner Bulgaria. As WorldMiner, we believe that blockchain mining should not longer be a privilege of the few, and everyone should have the access to its benefit in this future digital economy. Regardless of location or wealth, everyone should have the equal opportunities to participate and gain. We think that only together we can move towards a more inclusive, sustainable, and transparent future. That is the reason why WorldMiner strategically works with WorldCoin, or as it is rebranded to World, to shape the future of cryptocurrency together, aiming to address regulatory gaps in WorldCoin's global market within OpenAI's grand vision, to enhance its reach and influence. We trust in the market potential of our coin, ATM, that was developed to provide computing power that can help to fill the gaps left by WorldCoin, offering that substantial market opportunity. Users can acquire computing power at low cost, earn returns from WorldCoin and WorldMiner. WorldMiner and WorldCoin, both aimed at OpenAI's core initiative, have both developed a robust cryptocurrency financial ecosystem. Their market education, promotion, technical support are top tier, demonstrating strong capabilities. WorldMiner addresses the biometric policy barriers that was faced by WorldCoin in its global expansion by offering an unrestricted participation platform for users across multiple countries. These moves inject new momentum into WorldCoin's market value growth. With WorldMiner global promotion, both WorldCoin and ATM values are expected to double. WorldMiner introduces a staking mining model that eliminates the need for expensive equipment purchases. The user can stake a certain number of tokens to receive computing power allocation, enables participation in mining and earning rewards. Compared to traditional mining, staking mining significantly lowers entry barriers and reduces equipment and maintenance costs. The ATM token, positions alongside WorldCoin, is currently undervalued. However, with the expansion of the project, increased applications, the token price is expected to rise substantially, offering a strong potential. WorldMiner provides not only basic staking mining returns, but also offers additional rewards from various incentive programs and activities. So by participating in staking reward programs and computing power competitions on the platform, users can earn extra returns, further boosting their gains. So join WorldMiner today to shape your financial digital future. So in today's session, we will go through and explore the cryptocurrency, how it's been integrated with traditional finance, and how that involves explaining the relationship between decentralized digital currencies and the established financial system. So in recent years, the rise of cryptocurrency has sparked significant discussions, debates, and even disruptions within the world of traditional finance. Cryptocurrencies such as Bitcoin, Ethereum, and many others are decentralized digital assets that offer that alternative to government-issued fiat money. The form of digital currency is typically based on blockchain technology that ensures transparency, security, and decentralization. On the other hand, traditional finance referred to that established centralized financial system encompassing banks, payment networks, regulatory bodies, and financial markets. So the integration of cryptocurrency with traditional finance marks a significant milestone in the financial world. As blockchain technology matures and cryptocurrency gains wider acceptance, financial institutions, payment service provider, and governments are increasingly exploring ways to bridge these two systems. This integration presents both opportunities and challenges as both worlds converge. The potential to disrupt, innovate, and even transform financial processes, payments, and investment strategies has drawn attention from various stakeholders across industries. Cryptocurrencies began as an idea to create a decentralized and trustless financial system. The idea took root with the release of Bitcoin in 2009 by an anonymous figure known as Satoshi Nakamoto. Bitcoin's primary purpose was to allow peer-to-peer transactions without the need for intermediaries like banks or payment processors. Since then, thousands of cryptocurrencies has been developed, each with its unique features, governance mechanisms, and user cases. Bitcoin's success laid the foundation for broader adoption of cryptocurrencies, with Ethereum as its smart contract capabilities pushing the boundaries further. Ethereum allowed for decentralized applications, dApps, and programmable transactions, which greatly expanded the scope of what blockchain technology could achieve. Blockchain technology, the underlying framework of cryptocurrencies, provides a decentralized, immutable, and transparent ledger that is maintained by a network of computers, nodes, spread across the globe. So traditional finance operates on a centralized structure where central banks, governments, and financial institutions control the flow of money and transactions. In contrast, the decentralized nature of cryptocurrency disrupts this conventional model, offering financial sovereignty to users and eliminating the need for trusted intermediaries. So why is this integration so important? There are several reasons. One is the access to new markets, because cryptocurrency provides access to new and untapped markets, particularly in regions where banking infrastructure is underdeveloped. They offer a way for people to participate in the global economy without the need of traditional bank accounts. And then the efficiency and the cost, because we can lower the cost with blockchain technology because it facilitates faster, cheaper, and more secure cross-border transactions. And that is particularly important for global remittances and international trade, where traditional financial system could be slow, costly, and prone to intermediaries. And the financial inclusion. Cryptocurrencies offer the potential for greater financial inclusion by providing people with the means to access financial services without the need for traditional bank account. This is especially beneficial in developing countries where large segments of the population still remain unbanked. And cryptocurrencies has emerged as a new asset class, providing investors with opportunities for diversification. Institutional investors are increasingly invested in cryptocurrency markets, and financial institutions are creating new products such as crypto-based exchange-traded funds, the ETFs, to meet the demand. The convergence of traditional finance and cryptocurrency brings opportunities for innovation. Blockchain technology can enhance traditional financial systems through smart contracts, decentralized applications, tokenized assets, and other solutions that improves that transparency, efficiency, and liquidity in financial markets. So when it comes to the key areas of integration, well, one of the most prominent areas of integration between cryptocurrency and traditional finance is its payment and transactions. Cryptocurrency often and offers a means of transferring value digitally and globally, often with lower fees and faster transaction times than traditional financial system. Example, Bitcoin can be used as a means of transferring money internationally without the need for intermediaries such as bank or remittance services. However, cryptocurrency face challenges in achieving mass adoption as payment method. These include high transaction fees during network congestions, like in the case of Bitcoin, volatility in the currency value, and limited merchant acceptance. But despite these challenges, several major companies such as PayPal, Visa, Revolut, MasterCard has begun to integrate cryptocurrency payment into their platforms. In traditional finance, stablecoins, cryptocurrency pegged to a value of a fiat currency, has emerged as a popular solution for facilitating cross-border transactions. Stablecoin combine the benefits of cryptocurrency, fast and low transactions, with the stability of traditional fiat currencies, making them attractive for international remittance and trade finance. An example, Tron, the ERC, that has surpassed the Ethereum and the USDC as the USDT, has actually already made trillion in transactions. And that is putting a lot of eyes on stablecoins for trading in finance of major institutions. So banks and financial institutions are increasingly exploring ways to integrate their cryptocurrency into their offerings. Major banks like JP Morgan Chase, Goldman Sachs, Citibank has started to offer cryptocurrency-related services such as custody, trading, and investment products. So this marks a definitive shift from the early years of cryptocurrencies, where all the banks, most of them, were skeptical and even hostile towards digital currencies. So there is many drivers in this shift. Obviously, the customer demand, because the popularity in the mainstream is getting more popular in retail and institutional. So they need to offer a service to stay relevant, for example, the banks. And there's more regulatory clarities, since there is more regulatory framework today than ever that has established, makes it more comfortable for banks to be part to offer cryptocurrency services. And the advancements in technology, because they see the potential in blockchain technology, not only to streamline internal processes, to enhance security and reduce cost, and in combination with artificial intelligence, this is even greater potential. So a notable trend in this integration, for example, is the emergence of crypto-friendly neobanks. So this digital-first bank as N26 or Revolut in Europe, or Nu in Brazil, for example, that allows customers to buy, sell, and hold cryptocurrencies along their traditional fiat currencies. So by offering this seamless interface to manage both, neobanks are bridging the gap between traditional finance and the world of cryptocurrencies. And cryptocurrencies in the investment and asset management has emerged as a new asset class. And this has led to the attraction and the attention of individual investors, hedge funds, and institutional investors alike. So in response to this growing demand, traditional financial institutions are integrating cryptocurrency products and offering services. Investment vehicles such as cryptocurrency exchange-traded funds, ETFs, future contracts, and trusts are becoming increasingly common. Just like, for example, last week Dubai court announced that you can actually do your will with cryptocurrencies as well. That is kind of mind-blowing compared to a few years back. So products allows investors to gain exposures to the cryptocurrency market without having all the digital assets themselves. For example, the launch of the first Bitcoin future ETF in the US in 2021 marked that major milestone for integration of cryptocurrency into the mainstream investment portfolios. Moreover, asset managers are beginning to recognize the value of tokenization, which involves creating digital tokens that represent ownership of real-world assets, RWAs, such as stocks, bond, real estate, gold, anything. And that tokenization improves the liquidity and reduces transaction cost and enables fractional ownership, making it easier for investors to access a broader range of assets. And for example, in UAE, when it comes to this, where they are developing a lot, where they actually have now giving a few companies a license, crypto license for RWAs, meaning that they can legally tokenize in UAE, Dubai, for example, real estate and other products. And one of the most significant challenges in integrating cryptocurrency with traditional finance is navigating the regulatory landscapes. Governments and regulatory bodies around the world are grappling with how to regulate cryptocurrencies, particularly given their decentralized nature and potential for anonymity. Without a clear regulatory framework, financial institutions have been hesitant to fully embrace cryptocurrencies due to the concerns about legal and compliance risks. So in recent years, regulatory clarity has improved in many jurisdictions. For example, in the United States, European Union, and other regions have begun implementing rules for cryptocurrency exchanges, anti-money laundering, AML compliance, and taxation. And you can see that, for example, that got Binance US division with ZZ being imprisoned and paying a huge fines, billions, for not in the past have been compliant with their exchange. So it gives much more credibility today, all this, and trust to the end users. Governments are also considering how to regulate decentralized finance, DeFi platforms. And I think Dubai is one of them that has evolved mostly in this part. And that is to operate without intermediaries, and that may pose risks to investors and broader financial system. So the challenge for regulators is to strike that balance between fostering innovation and protecting the consumers. So overlay strict regulation could stifle growth in the cryptocurrency space, with a lack of regulation could lead to increased risk of fraud, money laundering, and market manipulation. When it comes to decentralized finance that represent that new frontier in the integration of cryptocurrencies with traditional finance, DeFi refers to the system of financial application built on blockchain networks that operates without the intermediaries, such as bank or brokers. The DeFi platforms allow users to access services such as lending, borrowing, trading, and investment without relying on traditional financial institutions. The DeFi ecosystem has grown rapidly, with billions of dollars locked in DeFi protocols as of 2024. The DeFi platform offers several advantages over traditional finance, includes lower cost, greater transparency, and access to financial services for the users who may be excluded from the traditional banking system. However, DeFi also presents risks, particularly related to security, volatility, and regulatory uncertainty. So the absence of intermediaries and oversight can leave users vulnerable for hacking, smart contracts bugs, and frauds. Furthermore, the decentralized nature of DeFi makes it challenging for regulatory to apply traditional compliance measures, such as Know Your Customers and AML rules, anti-money laundering rules. So despite these challenges, the growth of DeFi demonstrates the potential of blockchain technology to revolutionize financial services. As traditional financial institutions explore ways to integrate DeFi into their offerings, we may see new hybrid models that combine the advantages of both decentralized and centralized systems. While the integration of cryptocurrency with traditional finance presents many opportunities, it also comes with a set of challenges and risks. The volatility. Cryptocurrencies are known for the price volatility, which makes them less attractive as a stable store of value or means of exchange. The volatility can also introduce the risk for financial institutions and investors looking to integrate cryptocurrency into their portfolios. Cryptocurrency exchanges and wallets has been frequent targets of hacking and cyber attacks. So while blockchain technology itself is secure, the platform that facilitate cryptocurrency transactions are often vulnerable to security breaches due to its centralized servers where the trading of the currencies you have in your wallet or in the exchange is hot, meaning it's not as secure as it would be if you have it in cold storage off the grid in your wallet. Because you move money from your wallet or cryptocurrencies to the trading account that is hot, means it's more hackable and much more unsecure. And then the regulatory environment for cryptocurrencies is still evolving, and financial institutions face the challenges of navigating a patchwork of regulations across many jurisdictions. So the uncertainty around taxation, compliance, and the legal frameworks can create the obstacles for that widespread integration. And the scalability, because many blockchain networks, that includes Bitcoin and Ethereum, have faced issues with the scalability, particularly during times of high demand. Slow transaction times and high fees limit the effect and the effectiveness of cryptocurrency for large-scale financial applications. And the adoption barriers. While cryptocurrencies have significant attention, they're still not widely adopted by mainstream consumers or businesses. So overcoming these barriers will require addressing issues related to user experience, education, and the merchant acceptance. The future of cryptocurrency integration with traditional finance is promising, but it still will require continuing innovation, collaboration, and regulation, as more financial institutions, governments, and businesses explore that potential of blockchain technology and cryptocurrencies. So we can expect to see new products, services, and solutions that bridge the gap between decentralized digital currencies and the traditional financial systems. In the coming year, we may see emergence of central banks' digital currencies, CBDCs, which will further accelerate the integration of digital assets with traditional finance. And we have seen already stablecoin has been first approved in UAE, and we will see furthers being approved, I believe Tron as well. And that will the USDT. So I believe that you would see a lot of CBDCs, central banks, digital currencies, come to life in the coming years. Why? Because it gives the government or the banks, central banks, the means and the need to be able to maintain stability and regulatory oversight of traditional monetary systems and the efficiency. And moreover, as blockchain technology continues to evolve, solutions such as layer 2 scaling, cross-chain interoperability, and privacy-focused protocols would address many of the current challenges facing the cryptocurrency space. So these advancements could enhance many of the cryptocurrency challenges. The scalability of cryptocurrency transactions make them more viable for mainstream financial applications. So, in this month, DisruptionBanking.com published an article related to today's topics. This article titled "The Crypto Revolution, Bringing Traditional Finance and DeFi." You heard about Bitcoin, but you know how it's reshaping the financial landscape? So that article explores the intersection of traditional banking and decentralized financing, revealing the opportunities for both seasoned investors and curious newcomers, discovering how blockchain technology is challenging established norms and creating new pathways for financial innovation. So the world of finance is undergoing this seismic shift. As cryptocurrency and blockchain technology continues to gain traction, traditional financial institutions are scrambling to adapt. The convergence of old and new is creating fascinating landscape where innovation and regulation collide, offering unprecedented opportunities for those willing to navigate this evolving terrain. So it's not just about keeping up. These institutions recognize the potential of DeFi to revolutionize everything from lending and borrowing to asset management. So by embracing blockchain, they're opening up new avenues, both for growth and efficiency. And decentralized financing is more than just a buzzword. It's a whole new way of thinking about financial services. The DeFi platforms offering innovative products that challenge traditional banking models, from yield farming to flash loans. So for retail investors, that means access to a wider range of financial instruments on potential higher returns. But obviously it comes with higher risks and volatility. So understanding the risks and the new opportunities is crucial for anybody looking to diversify their portfolio in the digital age. And as we discussed, the regulatory frameworks and landscapes has to be in line for it to really have that growth that is needed. So what is the future of finance? Well, hybrid models and innovation. Yes, you will see hybrid models emerge, combining the best of traditional finance with DeFi that could lead to more efficient markets, increased liquidity, and greater financial inclusion. And for traders and investors, that means staying adaptable and open to new ideas. The financial world is changing fast, and the one that can navigate both traditional and decentralized will be the best potential to capitalize on this. So, WorldMiner is innovating staking mining platform, combines both artificial intelligence, blockchain, and cryptocurrency in a revolutionary staking way. Our staking system allows various staking options depending on your budget. So what is staking? Well, the staking process is locking cryptocurrency assets for a predetermined amount of time in order to support a blockchain operation. So staking your cryptocurrency earns you additional cryptocurrency. Many blockchains use proof of stake, where users stake predetermined amounts of cryptocurrency to support the blockchain by confirming fresh transaction to generate new blocks. In WorldMiner, you enjoy 4 different staking mining methods. Dual coin mining. The first and most important in our platform is dual coin mining, WorldMiner's product that is revolutionary. In this method, you require a minimum of 100 USDT in the value 70% USDT and 30% ratio of SAM coin, that is WorldMiner seed token, to start the mining process. This principle will generate every 24 hours not only WorldCoin but also WorldMiner coins. That is the WorldMiner's platform token in the same ratio, 70% and 30% ratio. The daily output, the reward, will be automatically transferred to your user wallet once it's been generated. And it has 4 different modalities. You can either do it for 7 days with 0.7% daily output, or 30 days with 1% daily output, 90 days with 1.2% daily output, or 180 days with 1.5% daily output of reward of 70% WorldCoin and 30% WorldMiner. And it's important that when the staking period is over, you can select to get all of your principal back, or you start a new staking with the same principal. And this methodology applies to any staking in our platform. ATM mining is the second staking mining in our platform method. Here you utilize the WorldMiner generated from the dual coin mining to stake to generate ATM coins at 1% daily reward profit for a lockup period of 10 days. ATM is one of WorldMiner's coin, and it can be traded on the secondary market. The third is our liquidity mining. And this method in our platform is very interesting because here you can stake either WorldCoin or ATM, or both if you prefer. You get a 1.5% daily profit on the same coin for a lockup period of 10 days. But the interesting part, if you decide to restake again after 10 days, the platform will grant you an additional 0.5% for the following period. This restaking process can be done until you reach a maximum of 5% daily reward. Bear in mind that the accumulated output percentage in this method is bound to each independent staking process you started. Our last staking method, Easy Earn, where you stake either WorldCoin or WorldMiner coin or both for a lockup period of 24 hours that receives a 0.7% daily profit of the same coin that you staked. So you can see they're pretty interesting gains, both from traditional or virtual markets. So install your WorldMiner application today and begin your successful and profitable journey with WorldMiner. I am Ola Johannes Lind, this group's the global CEO of WorldMiner. And thank you for this session, and I see you in the next session. Thank you.